Andrew, good morning to you. Let's start with jobless claims, and then we can get to all the rest of it. Claims are really, really low, and you've been looking for a much weaker labour market into year-end. Why doesn't that back up that theory?
It's a strange labor market. It's a different labor market than something that we've ever seen before, where we have really low hiring rates. We see the JOLTS data, we see the percentage of people who are getting hired into new jobs, and that number is low, so it is hard to get hired into a job. That's the bad news. The good news is what we're seeing in jobless claims, in the initial claims at least, that is showing us that the layoff rate is still low. So we have a strange labor market where it seems like people are hanging on to the workers that they have, but they're not necessarily wanting to hire more workers.
So you think 25 today, and you think 50 in December, and everyone else is thinking about 2025 and the prospect of rate hikes and not rate cuts. How useful is the price action of the last 24 hours to project out what 2025 might bring?
Yeah, I think not useful at all. I really don't think that you're supposed to take a macro narrative away or a Fed narrative away from what's going on in interest rate markets right now. If you look at what's happening in the macro fundamentals, we do have a softening of the labor market. I think that's clear after the last jobs report, where even after you adjust that jobs report for hurricanes and for strikes, and I think that's part of why the market can't react to it. We also had the election coming up at the time. But with all that distortion, it's hard to see, but if you draw a through line through it, what you see is the pace of job growth is slowing. You see the unemployment rate has risen from its lows, and it looks like, if anything, it's still trending higher, and that's going to make the Fed think there's some downside risk to employment. And then you move to the inflation side. We just got numbers for the third quarter, 2.16%. Quarterly annualized core PCE inflation. That's essentially at target inflation. So if you're the Fed, you're looking at inflation that's close to target, you're looking at an unemployment rate that's still low but maybe rising. The path is going to be towards lower rates. So I really don't understand the move in the market or the new narrative that this is a Fed that might need to hike. No, this is a Fed that's cutting.
I think a lot of people would agree that this Fed probably isn't going to hike, although there was this one person out there who did put out the prospect of potential rate hikes, a number of people actually. There is a feeling, though, that they can't cut nearly as much, especially at a time where the deficit's probably going to expand, and at a time where, even if it's not accelerating, this is an economy that's pretty solid. How do you push back against that?
Well, first of all, I'm not sure that it's an economy that's pretty solid. I know that we're seeing GDP growth that's running close to 3%. On the activity numbers, those look fine. Again, if you look at the labor market, it doesn't look as strong. And I think we just had a referendum in this country in some ways on the state of the economy. And the results were not positive for how people are experiencing this economy. And you see that in some of the survey data. You ask people, are jobs plentiful or are jobs hard to get? You see that hard to get number that's been coming up. You see a hard to get jobs number that's elevated right now. If you're the Fed, the mandate is employment and the mandate is inflation. Inflation that's close to target, you have a labor market that's softening. And remember, back in August, Chair Powell said, we would not seek or welcome any further softening of the labor market. That means you need to get policy rates down towards neutral.
But this really highlights how messy the data is and how we can't really understand it, because at the same time that you're saying that the election was a referendum of sorts and that we've seen this in sentiment, at the same time we're seeing the U.S. Citi surprise economic index rise to the highest level going back to April. At the same time, ISM services, the employment component, actually increased more than expected. So how much are you looking at, say, the rising inflation expectations as data to pay attention to or not pay attention to for the Federal Reserve?
No, I think it's a fair point. And I think the signal to noise ratio in the data is just lower than it used to be. And in some ways, we know why that's happening. If you look at the jobs report, the payrolls report, for instance, the response rate is much lower than it used to be. And that just means that that data is going to be noisier. And we see that in some of the revisions. We've had just consistent downward revisions to those jobs figures. So we get a jobs figure. You look at the Citi Economic Surprise Index as a positive surprise. The market reacts to that. Well, then I'm not sure if people are paying as much attention when a month later, 2 months later, sometimes a year later, right, with those preliminary benchmark revisions to the payrolls numbers that turned out to be 818,000 lower in terms of the level of jobs than we thought it was. Those revisions have been to the downside, and that means we're actually looking at a weaker labor market than we thought, but the market's already reacted. The narrative has already shifted. So what we're trying to do is look at the data as best we can, draw those through lines in terms of where things are headed. Yes, I would agree. Right now we're running good GDP growth. We have an unemployment rate that's low 4%. That's not a bad thing either, not a bad place to be. But the question is, where are we going from here?